Hey traders, this is Blake Morrow with Traders Summit, and with me today I have a very special guest. I have Mr. David Hay. He is the Co-Chief Investment Officer of Evergreen Gavekal, and he is the author of the book, I want to read it, Bubble 3.0, Who Blew It and How to Protect Yourself When It Blows Apart. David, it is so great to have you here.
Blake, this is a pleasure.
Yeah, this is our first time meeting, and I know before we hit the record button, I got to learn a lot about you. But tell us a little bit about what you do and what you do for your clients, if you don't mind starting there.
Sure. And we are, I think it's fair to say, dinosaurs, because we actually do research, hence the name Gavekal Research. And we're very fortunate to be partnered with those folks because they are one of the most prestigious macroeconomic firms on the planet with almost every, well, that's a little bit strong, but most of the major money managers are clients of Gavekal. So that gives us some real advantages, but we also have a large team of research analysts, which again, that's kind of just not done anymore.
Yeah.
But that's what you have to do. I mean, you can't, it's one thing to buy an ETF, it's one thing to buy a specific company. So we spend a lot of time, and we do, I think what's kind of differentiating is we do a lot of work in the income area. So we have a lot of clients that are, relatively affluent or very affluent, and they want cash flow from their investments. And that's an area where we think that's where we've added by far the most value over the decades is on the income side of things. And we'll go anywhere basically in the capital structure wherever we feel like we can get the best rate of return. But you mentioned the Bubble 3.0 book, which the idea being that, and I think this is a very important point for our discussion, is that what we saw that hit kind of a crescendo, a speculative, what I call peak insanity in 2021, was, I believe, the biggest bubble in human history, which is a pretty bold statement. But Bubble 1.0 was pretty big too. That was the tech bubble of the late 90s. And the NASDAQ subsequently went down to almost 80%. Then Bubble 2.0 was housing, where the Fed was really pressured by people like Paul Krugman and to a lesser degree, Paul McCulley, to create another bubble in the wake of the bursting of the tech bubble. And all these things are connected. And we just keep, the Fed just keeps practicing, intentionally or unintentionally, bubblenomics. And now we're seeing really the wages of this. And the real change that happened during COVID when we went full on MMT, modern monetary theory. But they did that as a result of everything that had gone on before, where they were constantly trying to, instead of let things kind of flush out, it's like, okay, we couldn't even have a mild recession after the tech bubble, which is all it was. It was a very mild, even with 9/11, it was a very minor recession, and yet they kept interest rates at Great Depression levels, which then just pumped all kinds of helium into that massive housing bubble and mortgage lending bubble, which almost crashed the whole global economic system. And then the results of that were QE1, QE2, QE3, sound like all the ocean liners, right? QE4 was official September 2019 during the repo crisis. And then the mother of them all, which was the MMT experiment, which has gone badly awry. So, that's just a little quick overview. And we did publish Bubble 3.0 in early 2022 on Substack digitally because we wanted to get out there ASAP, because we were convinced, which has turned out to be true, that Bubble 3.0 was ready to deflate. It was already partially deflating then, to be fair, but most of the deflation happened after that.
David, when you talk about the Bubble 3.0, I think a lot of analysts and macroeconomic folks will call it the everything bubble. But weren't we really? I mean, you talk about 2019 going into COVID before we went into lockdown. We were really on the cusp of finally a recession taking hold before we got plowed with all this excess capital globally by every central bank following COVID. So this just really accelerated the issues that accentuated the issues that we're dealing with right now.
I totally agree. I was predicting that we were going to get a recession in 2019, coming up fairly soon. And of course, we got a nasty one, although a very short one because of COVID, but I think one would have happened anyway. We were already in an industrial and profits recession at that point. And we hadn't gotten into an official one, and COVID applied the coup de grace.
Yeah.
So I totally agree with that comment.
Well, let's talk about this maybe extrapolate on it a little bit, because we happen to be in earnings season, and it's just kicking off. And how do you feel about this earnings season? Is this really going to be the top of the market as far as earnings standpoint goes with companies? What are your thoughts there?
My thoughts are pretty clear. I don't think there's any question that we're in the second quarter of an earnings recession. Q1 was down and Q2 is going to be down. You could argue if you backed out energy from the earnings of last year, it would have already been a very clear and multi-quarter recession. It was something like 35% of all the cash flow generated by S&P 500 companies came from energy related entities, which are only 5% of the S&P. Remarkable statistic. But it's now energy is you're going to lose that because the year-over-year comparisons are going to get real tough for the energy companies, and then you're going to have to deal with the profit margin squeeze that's going on. I mean, you realize a lot of these companies have to pay higher interest rates, and I think that raises a good point, because bigger companies, the best quality, have been able to term out their debt, and so they've got largely fixed rates to deal with, kind of like a homeowner that's got a fixed mortgage versus a variable mortgage. We can talk about that, because one of my biggest fears is the bursting of the global housing bubble, which was even bigger than the one we had that crested in 2007. But these bigger companies are in better shape. The smaller companies, and particularly as you get into the non-publicly traded companies, have a lot of floating rate debt. And those tend to be the engine of the economy. So that's going to be a problem. So I think you're going to see what we've already seen so far, where look at the big banks last week, good earnings, right? And they're gaining, although I've seen conflicting data on this, whether they're gaining deposits. I think overall, like a Schwab, which also reported surprisingly good earnings, they're losing deposits on the bank side, but that money's flowing into their brokerage side. So those kinds of entities are big and diversified enough that they can actually kind of take advantage of the situation. Whereas you look at your small and mid-sized banks, and I mean, they're bleeding deposits like they haven't in 40 years. This is really an epic fleeing of money. And I think what's really underappreciated is one of my key points about this whole banking crisis that I feel like most people don't talk about is the implications for velocity. Because you just think about what's happening at Schwab. So it's going from their high velocity bank part of the entity to the lower velocity. Most people are just putting it into government securities. Yeah. And Schwab gets a little bit of a fee on, not much. Now, if you start trading stocks, it's different, but it's really this mass shift of money from bank deposits into, say, T-bills, or government funds that own T-bills, or money that's held at deposit, with the Fed, they're paying 4.5% or whatever. So the key point here is that your kind of high octane money is being replaced by low octane money, and that has significant implications for velocity. And as you know, it's money supply, which is already falling. It's falling at a 2.4% rate in the last 12 months. That's almost unprecedented. In real terms, it's falling at the fastest rate since the Great Depression. That should raise some eyebrows. Now we've got velocity declining. So the classic formula by Irving Fisher is money supply times velocity equals basically nominal GDP, or price times quantity, but P times Q, but it really is nominal GDP. So if you've got both falling money supply and falling velocity, that is a wicked double whammy. And I just don't think Mike Wilson of Morgan Stanley is talking about that. Christopher Wood from Greed and Fear, but very few people are bringing that up. And that's going to linger. That's not going to go away as fast as some of these bank runs.
Yeah, and the money is shifting from like these regional banks to the big names, the Charles Schwab's or the Citibanks of the world. I mean, that's where as a services economy as the U.S. is, and a small business, generally speaking, economy that the U.S. is, that's going to take away a lot of that money supply is from those bank loans and from home loans. And you brushed a little bit on housing, and as I'd love to hear your thoughts on the U.S. housing market, just because rates, you mentioned variable rates, are they that common at this point in time to where it should raise eyebrows to the average investor?
No, not in the U.S. It's not like back 15, 17 years ago when Alan Greenspan was telling people to take out variable interest rate loans, ARMs, at the same time that he was drastically raising rates.
Right.
Most Americans kind of did like big companies. They termed out their mortgage debt. Where it's a different story is overseas. America is very unusual in having 30-year mortgage availability and in many states non-recourse mortgages, whereas countries like Canada and the northern European countries and Australia and New Zealand, where frankly the housing bubble was much, much, much greater than it has been in the United States, there's a lot of variable debt. So you're seeing some real pain in countries like Sweden and in Australia and Canada, and it's pretty much the whole world that got pulled into this. But I think the U.S. is relatively lucky. We also don't have the kind of overbuilding of new homes that we had, back 15, 16, 17 years ago. I think you could argue there's actually a shortage of new homes. Where I've been more concerned is with multifamily. And I think you're now seeing that happening. Rents are falling. Wall Street Journal had an article a couple of weeks ago that apartment prices nationally are down 21% from the peak.
Wow.
And there was a lot of overbuilding, still is a lot of overbuilding. It's taken longer to get these things on. That's kind of the counter argument. But overall, there's now a glut of apartments. And then there's going to be more because look what's happening in commercial real estate. It is an utter disaster. Office buildings in particular, and office buildings specifically are down 25% year over year in price. And that's a big number. That's why you're starting to see so many of these office buildings being returned to lender, jingle mail on an institutional level. So I'm convinced that that's another one of the major disasters that's unfolding right before our eyes. And 70% of commercial real estate loans are held by mid and small banks. So there's going to be some real serious, side effects from that, the implosion of that bubble.
Well, speaking of side effects, and this is something that I wanted to discuss with you, is the safe haven status of the dollar. We've heard a lot about deglobalization or de-dollarization, of the dollar, and the dollar has always been hailed as a safe haven currency for so many years. We've seen it where people try to move away, or countries try to move away from doing business in dollars. And then, a crisis happens. We see the dollar, all of a sudden, everybody realizes that the tide went out and they weren't wearing shorts. So they scurry to go buy dollars again. Is this time different in the markets?
Well, you're raising a very important point. And I think the answer is yes, this time is different because this was a pretty serious crisis that happened out of the blue when SVB went down, Silicon Valley Bank, Signature Bank, First Republic fighting for its life, then over in Europe, Credit Suisse, the shotgun marriage into UBS. That's pretty serious stuff, especially when people remember how the global financial crisis started with Bear Stearns and then Lehman, and really went viral. So typically, you would expect the dollar should have been really strong here recently, but it hasn't been. So I think that's a tell there that there is something different going on, and that we're not getting that same kind of flight to the dollar as in the past. And it could be because the dollar is viewed as not all that safe. Because really, how do most foreign investors hold dollars? With treasuries.
Yeah.
And certainly that's how most foreign central banks, and they're the big players, hold dollars, is with treasuries. I don't think they want to hold treasuries anymore, at least not longer treasuries. T-bill is one thing. But even if you're holding a T-bill and you're a foreign central bank, you've got the currency risk. So I do worry that we are in a long-term dollar bear market. I think we'll always be effectively the reserve currency because I don't think there's a replacement out there for the dollar, but I think it's losing a lot of its exclusivity and a lot of its important kind of around the edges. I mean, you're seeing more and more global trade being conducted outside of the dollar realm. And I think there's also been this weaponization of the dollar, where people get cut off, countries get cut off of SWIFT if they do things the US government doesn't appreciate. So it's like, wow, do we really feel comfortable holding our money in US treasuries that could be appropriated at a moment's notice? And I think the answer is increasingly no. And if you look at as the foreign central banks have been net sellers of treasuries in recent years, they've been net buyers of gold, particularly last year, but that's continuing into this year. So a lot of people say, why would you hold gold? Gold, it doesn't pay anything, and it's the barbarous relic, but the central banks like it. So that's one reason to think of it in positive terms, I believe.
Yeah, that is definitely saying something. So, David, you bring up a great point. Where's somebody going to go, or where will countries go? And so I'm assuming you think it is going to be a longer term process moving away from the dollar. But where will the reserves pick up? Do you think it's going to be in Europe? Do you think it's going to be in China? what currencies are going to be beneficiaries? Maybe back to the Great British Pound. What are your thoughts?
Probably not the pound. I would say the currency that I like the most right now would be the yen, ironically, partially because it's so cheap. But this is an amazing factoid if you didn't hear it. Now, it may have changed a little bit because the yen has rallied somewhat, but at one point a few months ago, labor costs were actually cheaper in Japan than they were in China.
Wow,
that's a pretty shocking statistic. But again, it speaks to how cheap the yen is. So I do think that as they are forced to gradually abandon yield curve control, which they've started to do, but it's still pretty much in place, that the yen will have a major up move at some point. And I think it's probably this year. So I like that. I think that probably the most likely contender to be kind of the alt reserve currency would be the yuan renminbi. And they've made it convertible into gold, for in many ways. I mean, if they buy oil, let's say from Saudi Arabia, and Saudi Arabia doesn't want to have yuan, they can exchange it for gold, and that makes it pretty attractive.
But still priced in dollars, though, right?
Still priced in dollars for the time being.
Yeah.
That may be where you start to see some changes, where you get some of these commodities that have at least another market that's not dollar based. But for now, that's the case. And
yeah.
And I think oil in particular is a fascinating market these days, and that is absolutely one of my favorite investments. And for some of your folks that can trade futures, I presume they can, right?
Yes, they can. Absolutely.
I think one of the greatest steals in the world is to buy long-dated oil contracts. You don't even have to trade them, although I like to. I'm talking my personal book. I've got a big position in 2024 crude as well as spot. But the idea that to be able to buy oil that's $6 a barrel cheaper a year from now, or $10 a barrel cheaper 2 years from now, in a world where oil is getting much more scarce, and where dollars and treasuries in particular are getting much more plentiful. I know you saw some of the stuff we wrote about with the government debt this year, but it's going to be I think that's one of my two, along with the global housing bubble, a potential federal fiscal financing fiasco, the 4Fs, is, I think, very probable this year.
Well, expand a little bit on that topic since we're there.
So if you look at just the Fed alone, it wasn't only a little over a year ago, that they were still fabricating about $1 trillion a year that they were using to buy treasuries. Well, now they're doing the opposite. So that was the famous QE that we know and dislike so much. But now they're doing quantitative tightening. So doing the opposite. Now they did reverse that for a few months because of the banking crisis. So their balance sheet is expanded again. However, it's not free money like QEs were. They're charging these banks, say 4.5% to go to the discount window to borrow money. So I think it is different. I would say it's kind of QE light, and they're going to get back on the track now. It's sort of calmed down at quantitative tightening. But also look at the federal deficit. I mean, it was up $400 billion in the most recent half fiscal year. So the federal government's on a September 30th fiscal year. The deficit in the first 6 months of this year, 1.1 trillion. So, kind of roughly a $2 trillion annual rate. That's pretty shocking when you consider, what inflation is still running at, which brings in more government revenue. But government revenues, even before you take in, it's not in real terms, in nominal terms, fell about 3%. Spending was up something like 14%. So the red ink is exploding. And then you've got, as I said, the central banks, foreign central banks selling. You're going to have the Social Security Trust Fund, the Medicare Trust Fund selling because they're not bringing enough revenue to cover their outlays. And who's buying? Well, the banks. Are they going to be huge buyers? There'll be huge buyers on the short end, but I think where you're really going to have a problem is with more intermediate and long treasuries.
Yeah,
a real buyer strike, and you could have a failed treasury auction this year.
Oh,
and that would be a shocker.
That would be a shocker. Well, the 4Fs sound kind of scary to me, and I actually now I'm so intrigued to go read your book, Bubble 3.0. That's going to be like the next place I go. But David, I really want to say I really enjoyed our time together, and I appreciate you being here on the Trader Summit with the trading community. But what's the best way for us to follow your work? Do you have a newsletter?
Absolutely. So just go to Substack, the Haymaker. That's our little logo in the background, my avatar, with the boxing gloves on, because it seems like I'm always throwing punches at something. But that's we have a free newsletter called Making Hay Monday that's very action item oriented. At least it's as trade specific as I can be with SEC, restrictions and handcuffs and so forth. And then we do a highlight reel haymaker on Fridays, kind of a review of what we thought was the most interesting developments of the week or recent weeks. So yeah, it's free. As I always say, it's everybody's favorite price. So go to Substack, Haymaker, sign up for it, and I'd be grateful.
Great. And, just so you all know, here at Traders Summit, we're going to be publishing some of Mr. Hayes' work. And also, if you like what you heard here and you enjoyed this conversation we had with David, jump in the comments down below. Tell him how much you'd like to see him here again and give him a big thumbs up. David, I want to say thanks for joining us here at the Traders Summit, and I'll look forward to our next conversation together.
As will I, Blake. Thank you very much.
Thank you.
Talk to you soon.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.